We like the plan, Alex. This has been many months in the making. So last December, they had actually reorganized the existing business into these two separate units, the TV business and then the streaming and the studio business, kind of eventually paving the way for exactly the announcement today. I think the surprising part, and this is a little bit of a pleasant surprise for Warner Brothers Discovery, has really been on the debt side. So as you well know, the linear TV business is challenged, but the bigger problem for WBD has really been a huge amount of debt. And this debt was really as part of the combination of Warner Brothers and Discovery, which happened a few years ago. At that point, the company had over $55 billion in debt. They've paid about $19 billion down, but they still have $35 billion. But what they're doing now as part of this transaction is they have a tender offer out there. They're really kind of looking to streamline the capital structure. So when you have these two new public companies, there's going to be a much more manageable debt load at both of those companies. And I think investors are really reacting positively to that news.
Geetha, when they put the companies together, one of the arguments was to create scale to compete against Netflix and Disney. What happened to that argument?
Yeah, exactly, Paul. Yes, they did create scale as far as the TV networks part of the business was concerned. You have Discovery, which is really the leader when it comes to nonfiction. You have, the Warner networks and HBO, which is the leader when it comes to fiction and quality dramas and scripted series. And they thought that would do well, but unfortunately, what happened is, and all media companies, as you well know, Paul, have this conundrum because they have the TV business, which brings in a lot of the cash, but is literally a no growth business. In fact, it is in decline. Both advertising as well as affiliate fees are in decline. But then you had the streaming business, which initially kind of had a little bit of trouble because, in that whole game of subscribers and that land grab for subscribers, they actually ended up incurring a huge amount of losses. But there is this whole wave of content cost rationalization. We've seen a turnaround in all of the streaming businesses, and Warner Brothers Discovery actually has kind of led the charge there. So they were actually the first to get profitable in terms of streaming. And so now we're seeing this huge disconnect, or at least they are saying that there is this huge disconnect between the TV networks business and the streaming, the studios business, which should arguably get a much higher multiple. Mm-hmm. And that's kind of the reason for this split. So we're seeing now multiple companies do this actually. So Comcast, which has the NBC division, they're splitting off their cable networks. We had Lionsgate and Starz, where you have Lionsgate as a independent movie studio, Starz as the media networks, and now you have Warner Brothers Discovery. So there's this whole big movement now towards, this vertical kind of separation, if you will.
I mean, do they all come together then and create kind of one less great TV network thing?
Yeah, that's kind of the plan. So the most logical combination, and this has been floated around for months now, is that with this news of the Comcast, the NBC cable network separation, would that become like this kind of roll-up vehicle? And that's kind of what a lot of the industry experts are thinking. They're expecting, now that you have this news today with Warner Brothers Discovery, everybody's kind of expecting down the road some combination of maybe that Warner Brothers Discovery TV assets along with the Comcast assets, and who knows who else kind of spins off their networks, and then that becomes this giant kind of TV network umbrella. Going back to Paul's point about scale, because scale really matters now in this business.